different quoting assets, USD versus USDC, the OKX perpetual trades consistently higher than the Binance perpetual. They are strongly tied to one another. Our first and second observations both tie into each other. The consistency in the price difference can be any of the three causes: stablecoin differences, USDC, USD, structural differences, contract differences. With stablecoin driven differences, we can easily adjust by tracking the prices of different stablecoins, and with contract differences, we can investigate how different the contracts between two exchanges are manually. We will explore the contract normalization as a topic soon. Finally, our differences may be entirely structural and related to the specific flows that occur on each platform. Whilst theories as to many vary, it's no secret that certain exchanges simply trade higher relative to others, likely because of how their indexes are constructed. There's also differences in their basis volatility due to how the indexes are constructed. A good proxy of this is the closeness to a total share of total market volume that the index covers. An index made of Bybit, OKX, and Binance will be very stable. But if it's driven entirely by an exchange's own spot market, especially a smaller exchange, when we divide the two assets by another, we get the spread ratio. This is useful for timing, as it's a lot more normalized between assets, but is not directly tradable. Trade opportunity here, spread ratio. Okay, so when the spread ratio has an anomaly, that's the trade opportunity. Okay. What we can actually trade is the difference, where we subtract the price of one asset from another, stablecoin basis. As we touched on earlier, the first step of normalizing our spreads is to account for stablecoin basis. The price of stablecoins, much like the perpetuals, varies by exchange, so we need to normalize based on this. If the exchange has the stablecoin market pair listed, then it'll be best to use this. In the event of depegging, we will want to switch off the system, so it's critical that the system has an edge ratio scenario for this. Otherwise, we may end up betting on the debug due to large discrepancies in stablecoin prices cross-exchange. This is not because the debug will cause the prices to be different, since we would of course have adjusted for this, but because during a depeg the prices vary drastically. We can look at Coinbase, which got a low of 93 cents on the dollar when USDC depegged, whereas the other exchanges only depegged for a few cents. KuCoin also depegged a lot more than others. Hence, unless we adjusted for the exchange-specific prices of stablecoins, instead of trying to apply some global price, we would have seen a basis between perpetuals that was a bet on USDC. Even if we did manage to adjust well, there's a good chance we would have still needed to monitor the system because of the significant variance introduced by the stablecoin basis. It's also worth remembering that some exchanges will write USDC or USD on the ticker symbolism, but when you read the documentation, they're marking it against USDC or USDT. There may also be USDC, USDT, and USD perpetuals for the same asset on a given exchange, and you can usually use the ratio between these to get an idea of the exchange specific rate for stablecoins. If one is not present, you can only use this proxy if the contracts settle the same way and have the same funding payment specifications. They don't always. Sometimes the USD ones are coin margined, and I've seen coin margined have different funding intervals to stablecoin margin perpetuals before. Normalization of contracts, converting perpetual prices from one venue like Binance to another, such as Bybit, OKX, or Hyperliquid, is complex. Using Binance's perpetual prices directly is not optimal, especially for platforms with shorter perpetual durations, like hourly ones on DEXs. This is because perpetual prices tend to converge towards the spot price in a pattern that resembles descending stairs until a funding payment occurs. which then causes a jump. We don't want to make trades that get us into a bad position on funding payments. An alternative approach of relying solely on spot prices is also flawed. It may lead to imbalanced positions favoring underperforming coins while shorting the surging ones. A potential solution is to clean the perpetual prices from a platform like Binance by accounting for accrued but unpaid funding payments, adjusting for rate differences, and then subtracting the accrued coupon for the specific platform you're converting to. This method is only moderately effective due to various challenges. Different indices used across platforms can lead to discrepancies, especially during volatile market conditions. There are limits on how high funding payments can go, which vary by exchange. Funding rates change frequently, affecting the conversion due to the nonlinear nature of the common funding formulas. Practical implementation issues such as determining accrued funding payments and adjusting for rate differences, considering the intricacies of funding rates formulas. The closest approach to a practical solution involves taking Binance's perpetual prices, adjusting the accrued funding payments and rate differences, and then recalculating the funding payments. However, there's no one size fits all formula for this, and you'll turn off specific exchange pairs or increase their entry thresholds in your system to try to counter this. An effective strategy involves analyzing data to understand how funding payments evolve relative to premiums and devising cross venue adjustments based on empirical evidence. This should include models for predicting how spot prices will converge across different venues. These are mostly driven by relative volumes on each exchange. We want to remember the notion of confidence throughout. If we deem two perps to be very similar, we can give a higher confidence to it and then size up on a divergence to a greater extent. How that score is developed is up to you as the reader, but generally it should include components like interval index formula, funding limits, and accrual formula. In any of these trades, the funding rate can play a significant role in divergence if contracts are misaligned. Thus, we should take these into account for our final live version entry exit timing. Timing our entries and exits for most firms is a simple moving average or perhaps even an exponential moving average with a set look back period. This look back period can be equated between the parameters for an SMA and EMA formula below. In addition to this, we have a parameter typically with a value of 2 to set the number of standard deviations from this threshold that will enter into a trade with a baseline assumption being that we exit when the price reaches the mean. We do not have to exit when price reaches the mean and can instead exit earlier. As we can see in the above diagram, the expected mean reversion between T1 and T2 written EM R T1, T2 in our diagram is proportional to the absolute z-score of the spread. The expected mean reversion roughly says how much we expect the absolute z-score to decrease by towards 0. Between two different time steps, I've drawn the relationship as linear, but it could be exponential or plateau out at a higher score, maybe even going negative, likely due to liquidation-based momentum caps on funding rates that you'd see these effects. We'd need to look empirically to see the true relationship, but the general idea stands for now. The issue is that the volatility of our spread can roughly be assumed to be constant, if anything. It is proportional to the absolute z-score, but let's call it a constant because it's an acceptable assumption for the explainer. The expected mean reversion is our edge. So we have a ratio between our edge and the volatility. As we see more of a reversion, the edge shrinks, but our volatility stays the same. So we get a worse risk-reward ratio as the spread reverts. When we add in the risk of mean estimation errors, differences in moving averages,
Make
parameters,
a choice, right? You just decide what it's going to be, who you're going to be, how you're going to do it. Just decide. And then from that point, the universe is going to get out your way. It's like it's water. It wants to move and go around stuff, you know.
Yo, keep the questions coming in, dude. If we get enough questions, I'll bring homeboy on. But if we don't, then no way. It starts to become questionable whether we should hold entirely to the mean or exist slightly before. Thus, we have a third parameter, our exit z-score. It is worth noting that these trades compete aggressively on the ability to beat fees, costs of trading. We could end up tying up capital. We could end up tying up capital for ages, sure, but we also could end up giving a couple extra BPS that mean the world to us when we're only working with a few bips after transaction costs in all likelihood. I write this all down so the traders can make their own decisions and so that you know what the experiments are that are needed to be conducted. Not so I can spoon feed the alpha step by step. No one will do that for you. Implementation. This section implements a backtest for a basic taker version of the strategy. We will explore a few different days of interest and go from data scraping all the way to our P&L plot. For me, at least, the pipeline looks exactly like this every time. Data scraping, data pre-processing, analysis continued, expanded analysis optional. In this case, I expect the analysis to be a basic opportunity test, and then from there, the analysis will develop a backtest. Then finally, we would do an expanded analysis which would include additional factors. Those additional factors would likely be latency or trading costs, which we vary to see the impact. Each of these 5 steps represents IPY and B notebook. The alternative for me would be an open PY file and start building tooling if I'm expecting this analysis to be more than just research. Other researchers need to validate my findings too. If it's going to take up lots of implementation resources like this strategy would, since lots of the alpha is on latency, data scraping, we'll be using tools like TARDIS as our data source. The most nice, dude. There's some alpha. Tick by tick order book snapshots. Cool, bro. Thank you. TARDIS. BitMEX, Deribit, Kraken, Binance. Okay. I wish I had access to some of these though. Okay, so he's doing some coding here. Half of these are default imports because the cost of importing is very low. And I typically copy paste the imports block from another block notebook. So realistically, there is no cost to importing libraries I expect to be using. Technically speaking, we can get away with just these. We're using Python, IPython environment. So we need to nest asyncio. JSON will be used to open source the JSON file with the TARDIS API key. The TARDIS dev is, of course, the TARDIS library for downloading. TQDM is a helpful library that makes the loops a lot easier to track the progress of. It's pretty helpful when you have hours-long downloads. We could end up using requests if we were fetching symbols from the exchange using... Okay. Before we do that, let's define this. So we're doing some requests here, pulling some data. Data dog's gotta be a data dog. So these are the exchanges using Bybit, DYDX. For tickers, I also want to filter by market capitalization. So it's all crypto, which is cool to see. Now let's define our look back date, data types, and open our TARDIS key here. Time to scrape the data. Here's a big chunk of my code that I usually copy and paste about. So it's going through the exchanges and getting the data sets for each symbol. My download directory is specifically set up based on the structure of my research data on my laptop. You may ask, why not do it all at once with multiple data types and multiple symbols? Well, that's because it has a fit if you give it too much data to download at once, so I prefer to do it in smaller chunks. But it is really up to you to experiment with a bit more concurrency in your downloads. Don't worry. If you get a ton of these, it just means that the symbol isn't on that exchange. Remember, all we need is for the symbol to be at a minimum of 2 exchanges. It doesn't need to be on all of them. You may also want to increase the date range we pull. I made mine short to save time, but I've used whole years for this kind of analysis in the past. I usually recommend doing a day and then going straight into writing the backtest code. Then you can rerun the data scraper to scrape more data. This prevents you from sitting at the desk reading the book paper whenever you do in this time, because you can claim the data is scraping. Okay. Data preprocessing, our data is normalized already because of the TARDIS formatting, but it's also GZ compressed and has a load of useless columns. Here's how we merge multiple exchanges. Okay, so this is nice. Gives all the code. I'm not going to read the code. This is pretty.